Hi guys, Cameron here. I have got another model for you guys to show everyone, and I'm pretty excited about this one. It's sort of a natural continuation from the previous video that we did on the single-family residential homes. If you haven't seen that already, feel free to check out either YouTube, where you can search Lotus Global Assets, or check out my website, lotusglobalassets.com/resources. So this model today that I'm going to walk you through here briefly, the multifamily model, and it allows for an investment period up to 10 years. And really this is for an investment and redevelopment scenario. So not meant for any development scenario, i.e. building the actual structure itself, but rather acquiring the property, putting some work into it, some capex, and then eventually looking to sell it off at a certain point in the future. So the level of complexity, I'll say, does ramp up a little bit from what we had seen previously, and that's kind of the aim of these videos going forward. And yeah, as always, feel free to chime in with any feedback, any kinks in the model that you notice, and I will be happy to update this. Without further ado, let's get into this. So here we've got on our inputs and assumptions tab, similarly structured to what you may have seen before if you've watched my previous video. We've got property information, pretty straightforward: city, state, zip code or postcode, depending where you are, and so on. Then we've got the number of units, which is simply a sum of the different unit types: studio, 1, 2, or 3 bed. We've got our number of assumed vacant properties. So we're going to say that shouldn't actually be 1. This should be, we've got on average, let's say half a property vacant throughout the year, or 1 property for 6 months, let's say, is more appropriate. Scrolling down a little bit further, we've got a market cap rate. So I'm going to show you how this applies momentarily into one of our valuation methods that we've used, because this model allows us to use one of 2 different methods for valuing the property in order to really kind of assess what we should be paying for it. The market cap rates can be based on comparables of similar properties, ideally in the same location, as comparable as possible. And all it's looking at is the percentage of the property price that's being returned through rental income. You've got a couple other details. So the average size of each unit on a square foot basis. You've got the total lettable square foot, which is just the sum. And then you've got your average rent. And once again, if you're new to these videos, you'll know, if you've seen my previous videos, you'll know that I don't put in currency units just because I try and keep it as sort of currency agnostic as possible. If you're in the US, if you're in the UK, it's all just in units. So what I mentioned before is that we've got 2 different property valuation methods. First, we've got the purchase price based on the market cap. This is where this 6% comes into play. And what this does is it takes, I'm just going to flick to the yearly pro forma for just a moment. It takes the forward NOI, so you can see here, it's the NOI at time t plus 1, divided by the cap rate to derive your purchase price. The second method uses discounted cash flows, which if I once again just pop over to the yearly yearly pro forma, what it does is it takes the unlevered cash flows and discounts it by the required unlevered internal rate of return, and this just sums them all up. So a quick sort of sense check, what you should be seeing is that between the purchase price based on the discounted cash flow and the unlevered internal rate of return, this is really our opportunity cost. So it's going to depend on what sort of returns the firm can typically achieve. A quick little sense check is that as the required return goes up, the purchase price should move inversely, i.e., required rate goes up, property price goes down. So let's just do a quick little check here. If we up this required rate of return to 15%, you're going to see that the purchase price does indeed go down. If we were to move this back to, say, 5%, you see that we're able to purchase it at a much higher price. Reason being is just intuitively, if you're discounting, you recall that we use this rate to discount the unlevered cash flows in the DCF method. If you're dividing by a larger rate, it's clearly going to bring down the value of the cash flows in your DCF. And really then what that's saying on the flip side is that we're able to only pay a lower price just because we have to hit a higher rate of return. So between these two methods then, what you're able to do just gives you a quick little nice drop down, select which purchase price, and that's going to play into the rest of the model here. Now, personally, in these scenarios where we're adding value through CapEx and renovation, the purchase price based on the DCF, in my opinion, is probably the better, more appropriate method to choose. Cap rates are great if you're acquiring a stabilized asset. You know, it's an income generating property, and there's not a whole lot of extra work that needs to be done. If there's going to be value added, now you can see anyways that the price only differs by about 40 grand, pretty immaterial. But if you're going to be doing some significant work to the property, this takes in all future cash flows, which are going to be the cash flows also not only prior and during the renovation works, but also post. It's just going to provide a better all-around picture for what the property is worth. So we're going to go with this method for purposes of this example. If we move over now to the deal assumptions, we've got our assumed hold period, and then just fundamental details when we are set to acquire it, then when we plan to sell it. Again, the opportunity cost or the required rate of return. We've got our entry cap rate. Really what all this is doing, say that it's quite similar to what the market cap rate is. This is just taking our forward NOI yield divided by the purchase price that we've selected. We've got our assumed exit cap rate, and then we've got our sales costs. So with this purchase price, what we are saying is that, and I'll flick over to the redevelopment costs in a moment, saying that the purchase price less the redevelopment costs that are needed, plus, let's say in this case, a 10% contingency on these costs. It's always good to bake in a little bit of room in case there's cost overruns and things like that. Offer price that we should be willing to pay maximum is 1.602626. We've got our financing structure details. We've got 25% down payment, our equity or the developer's equity, the investor's equity. We're saying we've got purchasing costs for our total equity required. Loan to value is going to be 1 minus the amount of equity that we're required to put in. You've got your financing details. So 5% over 30 years. and a 5-year term. Now, the difference between this model and, if you're familiar, if you've seen the previous one that I did on the single family rental houses, is that this financing assumes principal and interest payments. So we don't have the option for interest only. And importantly, what I wanted to point out is the debt service coverage ratio. Now, commonly in larger structures, debt structures, you're going to have covenants that the lender includes that says you've got to be able to service the debt and clear that hurdle by a certain amount. All it is your unlevered cash flows divided by the debt servicing requirements, so your principal and interest payments. And I've added some conditional formatting in here, which just flags it as red. If you've got your minimum debt service coverage ratio that's, for example, been included, this is going to flag as being red anytime that it's less than the required debt service coverage ratio. Just to call out that it's at some point or another going to dip beneath the required rate. Now, that's not to say, in practical terms, this is looking at it on a month-by-month basis. I'll show you this in the monthly pro forma in a second. It's not to say that as soon as you fall below this, if, for example, it's for a month, that the lender is going to run over and pull the loan from beneath your feet. All it is calling out to say, hey, at some point, you're going to fall below your debt service coverage requirements, and to be aware of it. And last but not least, you've got a couple extra fees that can be tacked on if you want, just points or origination fees. Moving over, we've got property level assumptions. We've got our rent escalation assumptions throughout the period. And we've got our terminal NOI growth for our discounted cash flow method. If it were to extend beyond the 10 years. Got our average vacancy, and then we've got OPEX details. So what you'll notice, and I'm just about to get to the redevelopment cost breakdown on a unit level, is that by changing these, actually, if you're smart, this will be, zero. Let the tenants pay their own fees. Then you're going to see that this just popped up a little bit. So it was 0.7 before, notched up by a few basis points. Just because this obviously frees up more cash flow for you to then service the debt. So what I'd recommend is having a play around with this. Another thing that's going to impact it as we get over into the unit level assumptions is the timing and the duration of the renovation itself of each unit. So here we've got our 10 units, the unit mix, square foot, and the current market rent. And what we're saying is that we've got a bunch of renovations that we want to include in, say, each of the units or none of the units. You're able to decide that in this model. By indicating the renovation start date plus the amount of renovation months, what you're doing is saying then, right, so after completion, we've got assumed market premiums that we're going to be able to charge on the rent itself. So, and then obviously your renovation costs per unit. This is another variable that you can have a play around with, and that's going to impact everything from your returns, your debt service coverage ratio, and things like that. So just make sure that you pay attention to this in terms of, the timing of when all these renovations are going to occur. Might not be a good idea, for example, to have 9 out of 10 units all being renovated in the same 3, 4, 6 months. It's because you're going to take a serious hit to your cash flows. So quite a bit of flexibility in that. If we flick now over to the rent roll, really I've broken this down into a few different scenarios. So you've got pre-renovation, you've got your yearly rent per unit based on current market assumptions and rental growth assumptions. Then you've got your monthly rent with the renovation. What you'll see is that after the point at which we've assumed that the renovation is going to take place, you'll see a market premium being added that we indicated in the previous tab to the rent. I've made a little calculation here that hopefully simplifies it for you. Anytime that you are, just zoom in a little bit, anytime that you're to the left or previous, prior to the beginning of the redevelopment period, you're going to be getting the existing market rent. Anytime during the redevelopment period, I've assumed that you're getting zero rent. Now this may be subject to your particular certain circumstances. And then after the redevelopment period is when we get our assumed market rental premium. So in this segment here, we've got the gross rental revenue, which shows you exactly how it all kind of plays out. So in unit 2, for example, we're saying that the redevelopment takes place between the 1st of November and the end of February, with rent starting back up on the 1st of March. So if we were to look and see how these cash flows play out, you should expect to see zero cash flows happening between November and February, as it does. And then we've got our rent plus the increased premium from the renovated unit starting back up in March. And down below, we've just got, we've explicitly just called out the development costs so that it's easy to see. So I've built in a monthly pro forma, nothing special here, just got your price, your rental income, less your operating expenses to give you your NOI. And you've got a CapEx reserve, just assuming that we're stowing away a certain percentage of money each month. The CapEx renovation and the payout from funds really just are there to offset each other. So you can see that anytime there's a CapEx expense, there's a corresponding payout from funds. This gets you to your unlevered cash flow. It's just a summation of the NOI less the CapEx. And then you've got your debt servicing assumptions beneath to get your levered cash flow. This is the debt service coverage ratio that I was mentioning before, which is important in some circumstances. But again, if it's a relatively small mortgage, probably nothing to worry about. Just always check the covenants, the terms that the lender stipulates. Here we've got, quickly just to show you the calculation, the unlevered cash flow divided by the loan payment on a monthly basis. You've got a breakdown of your unlevered and levered cash flows. So we can see here a 9% unlevered IRR over the 5-year period, or an 18% levered IRR over the same period. We've got a yearly pro forma, which summarizes everything from the monthly. Extra features in this is that I've included an cash-on-cash return. Really all this is your operating cash flows as a percentage of the purchase price. And here are your levered cash-on-cash return. And what we're seeing here, actually, if we just take a quick glance at the unlevered cash flows versus the levered cash flows, it really sort of makes sense, is that in the unlevered instance, you're not having to worry about debt. So the cash-on-cash return is quite a bit higher than in the levered scenario, just because of the increased debt burden relative to the rental income that you're able to achieve in the first couple of years. What you'll notice if you look at this model closely is that a lot of the renovation actually occurs in the second year. So this makes sense that the cash on cash return is particularly low in this scenario. But then afterwards, you've got your levered cash flows, as we would expect, given the higher risk of having debt, which are surpassing the unlevered cash flows, cash on cash return. Over here, I'll just quickly show you, we've got the amortization schedule with the assumptions that we inputted on the inputs and assumptions tab. And this is just a quick schedule to show you how, on a monthly basis, amortization plays out. So wrapping things up, if I flick back to the inputs and returns page, I've also included a little space for a picture if you want to include that down here as a reminder if you're looking at maybe a bunch of different opportunities. We've got a results sort of summary screen. Now, word to the wise is that this model is a little bit temperamental. What I mean by that is you're going to have a play around with the actual, again, the timing and the duration of the renovation, because what you'll notice is that based on these cash flows, it can sometimes throw a hiccup in the IRR calculation. So without getting too much into the weeds, IRRs are pretty finicky in terms of the how the different cash flows play out. If it doesn't meet some of the rules of an IRR calculation, it's going to throw up an error like this. Now, that's not to say it's always the case, but it can occur. So over the course of the various hold periods, we've done a quick sensitivity analysis based on how the levered IRRs can change, as well as the corresponding equity multiple and your net cash gain. And here we've just got a summary of the levered returns, how many you actually gained, and what the sale proceeds are. So that's it, guys. I hope you enjoy this model. It's been an interesting one to put together. Like I say, the complexity sort of ramps up compared to the single family investment model that I showed most recently. If you like these models, again, have a look on YouTube, search Lotus Global Assets. I'll have a link built into this model. And as always, it's free to download from my website, www.lotusglobalAssets.com/resources. Hope you guys enjoy it. And please do leave me any comments if you see anything that can be improved upon. And like I said before, I hope that my intention is going to be that I include or start putting out more regular investment models, gradually ramping up the level of complexity in each case to amass a bit of a library for you guys to use. Thanks very much, and I'll see you all soon.